Like I mentioned, my name is Ramon Santillan. I'm a tax accountant, a tax professional here in Dallas, Texas. I've been around the business for close to 20 years. I started in 2002. I'm a graduate of University of Texas at Austin in the accounting program, which is the #1 accounting program in the nation, or at least it was back then when I graduated. I've had experience working with high net worth individuals, preparing their taxes. I've worked with the big four accounting firms. I've worked at the big Fortune 500 companies. I worked at the world's biggest oil driller. I worked at the company, the biggest funeral home in the world. I've had my own tax practice. And for the last 10 or so years, I focus on, actually, I have my own tax practice. And for the last 10 years or so, I've been focusing on helping and working directly with business owners, not just in the U.S., but across the world, who do business in the U.S. and answering their tax questions. The past few years, as some of you may be aware, there's been a lot of questions about crypto, a lot of questions about, day trading, and how to minimize your tax burden when you're dealing with those types of income streams, and also just entrepreneurs. Several years ago, this is kind of close to about 10 years ago, someone making money off of Amazon was weird. A lot of my clients came to me because a normal CPA, a quote unquote normal CPA, wouldn't take them on as clients because they didn't believe that someone could be making that much money on Amazon, or on online courses, or just some other alternative methods of making money. So I had a client who was a dancer of the exotic kind, and she was actually very, very smart. And she said, I make like $200,000 a year, and she's like, I know this is not forever, but I want to do a couple of things. I want to pay my taxes, so I don't get in trouble. I want to, save for retirements. I want to be able to buy a house, and for that I need financial records, and I need to do it in a way that makes sense. She had gone to 4 CPAs, and none of them took her on because they said that it's crazy. That's like, you can't do that. You can't make $200,000 dancing. And she's like, well, I am, and I'm not the only one. So anyways, I helped her out, and she was very happy. And again, I've had clients from across the world, not just in the U.S., but from other parts of the world who either do drop shipping, they sell on Amazon. And again, things that maybe 10 years ago weren't a thing. And now they are, very much so. And a lot of you guys and girls out there are probably making good money out of it. So what I'm going to cover today is we're going to talk about some how to identify, reduce your tax burden by identifying expenses you can take.
You're going to want to turn your screen share on?
Yeah, I'll do it in a second. Okay. We'll cover how to avoid pitfalls with IRS, raising any red flags, and things to keep in mind. Again, you guys out there might have different kind of businesses, and it's always good to just have a good idea of what's out there and prevent any troubles, and also foresee any troubles coming your way. So I'm going to go ahead and share my screen. And again, if anyone has any questions or anything is unclear, feel free to let me know, and I'll be happy to answer the questions. So just a little bit of housekeeping. And again, thanks Atlas for inviting me. Here's a little bit of my background. And I'll make this presentation available to everyone at the end. If you guys have any, if you want to see any of the links that I put on there. Just housekeeping. You can read that there, but I'll read it out loud to you just to make sure everyone's clear. This material has been prepared for informational purposes only, and it's not intended to provide and should not be relied on for tax, legal, or accounting advice. You should consult your own tax, legal, and accounting advisors before engaging in any transaction. I know Atlas mentioned earlier when we talked earlier this week that some of you guys and girls out there might need help with your taxes. I actually focus more on the consulting side. So if you have any questions, I'll be happy to answer them. We can set up a time. We can go through your business and guide you through that. But if you want to get your taxes prepared, I can refer you to 2 excellent CPAs who focus on preparing taxes for businesses and high net worth individuals. So I can definitely give you that information later on. A lot of people they no one likes to pay taxes. A lot of people actually hate it, and they try to avoid paying taxes. And there's a lot of good quotes out there about taxes that I really enjoy, and I'd like to share some of them with you. So this one's death, taxes, and childbirth. There's never any convenient time for any of them. And that's Margaret Mitchell, author of Gone with the Wind. So we'll start with capital gains and losses. I know a lot of you guys out there may have some, maybe dabbling with day trading, maybe some crypto stuff, or maybe just your businesses, what you have. So things that you, money that you earn, that are wages, salaries, bonuses, is considered earned income. There, it's just you pay regular taxes there, like anyone who has a W-2 job or any kind of, income coming in. If you have any trading income from crypto or day trading, that's called investment income. There's two types of so for your wages, there's just a regular tax rate that comes with that. I'll show you the tax tables with you in a second. But if you have investment income, it's actually taxed at two different. There's different rates, but there's two different types of, rates where you would tax on them. So there's long-term capital gains and short-term capital gains. What's the difference? Pretty straightforward. Long-term capital gains are gains that you had on assets you kept for longer than a year, like 12 months. So if you buy a stock or crypto for that matter, and let's say you bought in January 1st, 2021, and the next time you sell your crypto, for gain or loss, doesn't really matter, is January 2nd, 2022, that's considered over a year, that you had it over a year, so your capital gains or losses will be considered long-term. And your tax rate would be 15%. If you have a short-term capital gain, so I know a lot of people probably out there probably messed around with the meme stocks earlier this year, like the GameStop, what was it, the other one, AMC, and they bought them for one day, they waited, or maybe this was the next day, maybe it's called a couple of days, or people are doing crypto. A lot of times, they'll buy when it's low, and once it has a big bump, they'll sell it and get their money back out. So those are considered, if you do a buy and a sell, and the period is less than 1 year, it's considered a short-term capital gain or capital loss. And those are actually taxed at higher rates. And you can see right there, tax up to 39.6%. A lot of times people, when they do day trading, they mistakenly feel like they're making a bunch of money. And actually, that's not true, because you have to take into account your taxes. There's a famous quote, and actually I think I have it in this presentation, but the quote says, "It doesn't matter how much money you make, it matters how much you get to keep." And the quote's related to gambling, because again, a lot of people say, "Oh, I made $100 or $1,000 or $1 million at the casino." It's like, wow, like that's awesome. Like, so how much do you get to keep? It's like, well, I actually lost it all, and then I should have lost another $500,000 on top of that. So again, it doesn't matter how much you make; it matters how much you keep. Sometimes when you're doing that day trading, you have to make sure you're aware of your tax rates, long-term and short-term losses, because again, that might be the difference between making money or losing money. Here's the tax rate table, and you can kind of see this right here. Pretty straightforward. If you're the more, it's not necessarily the more you make, the more you pay, but if you look at the tax rate tables on the IRS website, and you can just go to the irs.gov website and put tax tables, you can see that the incremental amounts of money you make increases a little bit of the taxes. So if you make, let's say, again, as an example, let's say that you make the $418,000 in money, your tax rate would be 20%. But it doesn't mean that if all the money is taxed at the at the 418%. It means actually just anything above the 418%, 418,000 will be taxed at the 5% higher rates. So it's not like everything gets taxed. So again, no matter what you're out there and politicians, left or right, we have it pretty easy here in the United States as far as tax rates are concerned. If anything, you see what our tax dollars do out there. We have paved streets, we have electricity. Here in Texas, we have electricity as long as there's no snowstorm. But we do have those things we see. We have police that we can trust for the most part. We have firefighters. A lot of countries, they pay taxes and they don't see those services out there. So, but anyways, here you see the difference between the tax rates for the long-term gains and the short-term gains. So, for example, again, let's say you sold some crypto or some stock. You bought Tesla at the beginning of the year. It's doubled already. You're like, hell yeah! Like I'm gonna sell it and buy my own Tesla. If you held the stock for longer than a year, your tax rates would be 20%. Let's say again you made $418,000 or more. The tax rate would be 20%. But if you held it for less than a year, your tax rate would be 39.6%, 19% more, almost like 20%. 20% more, almost double the taxes. So that's why if you are going to do day trading, you have to be very careful on this because you can definitely go, again, 20%. That's a lot of money. And again, there might be the difference between making money and actually losing money. Any questions so far? Okay, we'll go to the next thing. Here's kind of what I was talking about. The next tax quote. I like to pay taxes. With them, I buy civilization. Again, here in the United States, we are very lucky that we can see our tax dollars at work. Could they be better? Probably. But at least we see something. A lot of other places don't. Okay, so here we're talking a little bit about business expenses, but this involves also anything you have to do with trading, whether it's your trading commissions for stocks or for crypto. Rule of thumb is for what is a business expense. So a business expense is this, and here's the rule of thumb. If you would not have had that expense if you did not have a business, then it's not a business expense. Let me go through that again. If you would not have had that expense if you did not have a business, it is not a business expense. The other way is true. I guess an easier way to say is this. If the only reason you're having that expense is because you have a business, then it's a business expense. Here's a quick example. A business card. If you didn't have a business, would you be buying business cards for the business? The answer is no. It's like, well, there's no business. What kind of business card would you get if there's nothing to put on the business card? So in that example, the business card is a business expense. Let's say a computer. Would you have bought a computer for a business? Would you have bought a specific computer if you didn't have a business? The answer may be no. Like I need a specific computer for my trading, or I need a specific computer for my graphic design work. So no, like I would not have bought this computer had I not had a business. Sometimes, like for example, in my case, and I'm sure other of you out there are in the same situation, you have a computer that you use for both business and personal use, or other expenses. For example, internet. I'm using my home internet right now, but this is business. I'm doing business right now. This is not. I'm not doing this for fun, right? So what do you do in that case? In that case, there's several things you can do. You can do whichever one's easier. You just have to be consistent on it. You could do business use percentage. So, for example, let's say I have this computer. I have this Mac that I'm using right now, and I'm using it for business, but I also use it for personal. I check my personal email here every once in a while. I look at my Facebook. I share memes with my friends through the messenger and all kinds of stuff. Those are not business related. But what I do is like, okay, how much of it is business use as opposed to personal use? And you can kind of estimate there. Again, the IRS is not going to come back and ask you like, no, well, you send 100 texts, but 75 of them are business or personal, and the other 25 you set the other way around. So like, we're going to fine you. Like, no, they're not going to do that. So just take again, if your computer costs you $1,000 and you feel 70% of the time is for business, then you can expense the $700 $700 as a business expense. Why? Because 70% of it, according to you, is being used for business, and the other 30% is personal. You can do that with your cell phones. You can do that with your cell phone plan, for that matter. You can do that with your electricity at home. Let's say, for example, again, you spend $100 on electricity a month, but some of the electricity is being used for, meeting with clients or, sending bills out there and that kind of stuff. That's what you would do. You would just take a percentage and figure out what are the percentage that I use. Another way is this kind of works a little bit too. It's let's say you have a home office. Prior to the last administration, you can deduct your home office. You can still do it. However, our standard tax deduction is a lot higher now. So you would really have to, I think for single, okay, so I guess let me a little bit about background. When you do your taxes, you fill out your 1040, let's say you owe, I don't know, $20,000 in taxes, whether from your business or your W-2 or whatever. Everyone in the United States who is a U.S. citizen gets the standard tax deduction, where for single, I think it's $14,000, and for married filing jointly, I think it comes to $24,000 or something like that, 26 maybe. So if you're doing your tax, let's say you're single, you owe $20,000 in taxes, but then you have the standard deduction. You can reduce your $20,000 taxes minus $14,000 because that's your standard deduction. So then you really only owe $6,000 in taxes.
That applies to capital gains.
Yeah, that's just like after when all is said and done, and you owe taxes. That's where your standard deduction comes to play. It comes after. So when you put all your it's called adjusted gross income, AGI. When you put all your long-term, short-term, W-2, gifts you receive and that kind of stuff, you have your adjusted gross income. From there, you take the credits and that kind of stuff. At the end, whatever's remaining, you would apply your standard deduction, and then from there, you determine if you have you owe taxes or you get a refund. So yeah, that's kind of how that works. The last administration, they put in a really high standard deduction. So I think for married filing jointly is like $24,000. For single, it's like $14,000 or around $12,000 to $14,000. Let's say, I can't remember exactly. So if you have, there's this thing called itemized expenses, itemized deductions. I'm sorry, where if you add up all those things, and it's higher than your standard deduction. So again, if you're single, let's say the number's 14,000, but you have a lot of medical expenses, you have a lot of donations you give out, you have your home office expense. If it's more than 14,000, then it's to your benefit to use the itemized deductions. For most people, again, if you're single, you have to come up with 14,000 in deductions, itemized deductions. It's very hard. Keep in mind, I'm not talking about business expenses. That's a whole different thing. So for most people, we're going to use your standard deduction, unless you're like, again, it's usually for very high net worth people who, again, someone who donates $1 million a year. Like obviously that's more than $14,000, so they'll probably use the itemized deductions. not through standard deduction. So going back to the home office. Let's say you have a home office, and the rule says that you have to use that little home office just for your business. Some people use a garage or whatever. What do? You take the square footage of your house, figure out the square footage of your little home office, and then get that percentage. So again, for easy math, let's say you have a 2,000 square foot house. Let's say your home office is 100 square foot. So that means you have 5% of all the expenses that come in related to the house can be used as a business expense. So again, 2,000 square foot house, 100 square foot home office, that's 5%, right? 100 divided by, or 2,000 divided by 100. And then from there, let's say your electricity comes up to $100 a month for the whole house. Then you can see, well, 5% of it is for the little home office. So I'm going to get $5 from there. Let's say your internet too. My internet, it's $100 a month also. So that means another $5 there. Sometimes you might say, I use my internet more for business than I use for personal. Actually, I don't even watch Netflix or anything like that. I just use it for my business. You might decide it's better for you to expense the whole your internet plan. So instead of taking the $5, you might take the $100 if you feel that's right for you. Again, the odds of the IRS coming for you for $100, $5, or whatever are very, very low. Those guys have a bigger fish to fry than figuring out like, hey, this guy put $100 a month in internet. Like, I don't know if that's true or not. They're not going to bother with that. So that's kind of how business expenses work. Here's one that's real common. Sometimes people get tripped up. Let's say you go to a conference that is related to your business. What is tax deductible? What is considered an expense? Okay, for tax purposes, an expense would be, as long as you spend more than 50% of your time doing business-related things on that trip, you're able to expense the whole thing. So let's say you go to Disneyland. Again, it's very popular. That's why Disneyland does a lot of business on conferences, because you can kill two birds with one stone. And let me explain why. Let's say you have a conference in Disneyland for whatever business you're in. And you say, what? I'm going to take my wife and kids because, I'm going to be able to spend some time with Mickey Mouse and it'll be cool. They'll enjoy it. So let's say you go for 10 days. Again, easy math. You go for 10 days. Out of those 10 days, you spend 6 days of those 10 days doing conference stuff, business related stuff. So you go to the conference, you go to the gala, you go to meet people for lunch. And then after the conference is done, you spend another 2 days, following up on those contacts and that kind of stuff. And then you stay an extra 4 days at Disney World after the conference is done, sightseeing with your kids and your wife, or your husband. You say, what? Let's go. You spend 4 days and go to the rides, all that stuff. You're able to deduct the flights, the hotel, any conference costs as a business expense. You won't be able to deduct your kids' meals or anything because that's not business related, right? You wouldn't have that expense as a business expense. But you can, at least the 6 days of hotel, you can expense that. The flights there and back, you can expense them. Again, some people are brave or, stupid, depends how you see it, and they like to bend the rules, and they might expense their flight, their wife's flight, and the kids' flights. I don't know if I would do that. But, it's up to you. Again, the IRS is probably not going to come after you, but keep in mind that, peace of mind costs money. And if you're going to stay up all night wondering if the IRS is going to come flag you for something you did that you knew was wrong, that's fine. You go for it. But I like to sleep at night. I like my clients to sleep at night. So we work with the rules. We make them work for us, but also we don't break them. So again, you can decide what you want to do, but the business expenses, those were all business expenses. Getting to the conference, coming back, Conference fees, any meals you bought during the conference, those will be deductible. Speaking of meals, here's another one that's interesting. For tax purposes, again, there's a thing called GAAP, which is Generally Accepted Accounting Principles, GAAP. There's GAAP rules, and then there's tax rules. GAAP rules is just regular accounting rules. So, for example, anything that's a business expense can be deducted 100%. For GAAP, and sometimes it's called corporate book or they call it book. For the tax rules, for the tax book, some things are not deductible at 100% rates. So, for example, for GAAP rules, if you take someone out to lunch for business, you can expense that 100%. So, let's say you spend $100 on dinner with potential clients, you can deduct that 100%. However, if you spend $100 on a potential client for tax purposes, when you're filling out your tax return, you can only deduct 50% of that. Why is that? The IRS made a rule where they didn't feel like they should give people tax breaks because they were spending money that didn't need to be spent on like that, on like having fun stuff. So, for example, if you, because I think what really happened was this, like some businesses, and again, it's not you or me, it's like the big boys, like, you know, the Enrons of the world or the Amazons or whatever. I think what was probably happening is that those guys were saying, hey, you know what? We need to come up with some expenses. I know what. Let's have a big ass party, like a $5 million party, and that way we can increase our expenses and reduce our tax liability. And it's like, you know, we're going to have a big ass party, and guess what? Everyone who shows up gets a Ferrari or something like that. So, you know, in a way, they're counted as a business expense and they're reducing the tax liability, but it's like they're still getting a benefit out of that, you know? Like, you know, what kind of party gives you a Ferrari because you attended? So I think the IRS got wise to that, and they wanted to prevent people from abusing the law or abusing the rule, and decided that stuff like that is only 50% deductible. So that way they wouldn't really think about it. Well, we're not really getting $5 million benefit. We're only getting 2.5, and it's like, well, we're still spending $5 million. Maybe use it on something else instead of a big ass party with Ferraris in it. Okay, so that's like that's if you're doing something fun, I guess would be the word. So it's called meals and entertainment. You know, if you're having a lunch with a potential business partner or whatever, that's a 50%. Okay, here's the tricky part. What if you guys at your business, let's say you're, again, a lot of you guys and girls out there for Christmas, this is your busy season, and you're getting a lot of orders, and like, you know, we got to ship them out because we got to meet it has to get there before December 24th. Otherwise, you know, people are going to be pissed. So you say, you know what, guys, I know you guys are busy packing boxes and stuff like that. I'm going to bring some pizza for you guys. So that way you guys don't have to go. You can still have your lunch break, but you'll be here and you don't have to go out somewhere. And that way you can, you know, don't lose a lot of time, you know, going to get lunch, coming back. In that case, you can expense for tax purposes and for book purposes 100% of the cost of the pizza. Why? Because that is business related. And if you didn't have a business, you wouldn't have to spend that money. Like you wouldn't be buying pizza for your employees to work overtime if you didn't have a business, right? So in that case, you could spend 100% of it. It's not considered meals and entertainment. It's just considered food, you know, business expense. And you can deduct 100% of it. So anyways, I'm letting you know so that in case you're doing your own taxes and you want to make sure you know exactly what you're doing, or if you're having someone do your taxes for you, you can let them know, like, hey, this is kind of what this, and you'll know why. You see, maybe for business purposes, for GAAP, the Generally Accepted Accounting Principles, you see $100 expense, but for tax purposes, you only see 50, half of it, and that's the reason why. So again, any expense that you have because of your business is a business expense. Any questions on maybe some expenses you had that you're not sure if it's a business or not? I think I heard someone. Anyone?
Well, we should talk about a car and some of the ones that people would want to get bigger, you know,
Oh yeah.
bigger
So
reductions.
yeah, exactly. So thank you for bringing that up. For vehicles, again, different ways to calculate how you want to expense it, but usually there's actual cost, which means if you buy, $50 in gasoline for your car, you can expense the $50. And if you pay a mechanic $1,000 to fix it, you can expense $1,000 as a business expense. There's mileage, which most times is actually more beneficial. Mileage is, I believe it's like at 52 cents a mile now. Don't quote me on that, but I mean it's pretty high. Usually it's more beneficial. So mileage is for every mile you drive on your car, you can expense. You can take 52 cents as an expense. And I mean, right off the bat, it's real easy to figure out that it's more beneficial. How many miles per gallon do you get on your car? Again, easy math. Let's just say you get 10 miles per gallon, which is probably like a really bad mileage, but again, easy math. If you get 10 miles per gallon, and you can get 52 cents per mile using the mileage rates, how many dollars is that? So 10 times
$5.
$5.20.
Right. So it's $2 gain.
Yeah, if you're paying $3 on gas, right? Some places in California have a higher gas, but again, like you're probably still going to end up on the positive side. The actual cost will be more beneficial if you have a real shitty car that breaks down all the time, so you have a lot of expenses. But then, if that's the case, my question would be, like, why don't you just get a better car? So mileage usually is better to use here as opposed to the actual cost.
What about actual purchase of a vehicle? I do know some of the members in here are starting to,
Usually,
if you get a vehicle, how's that percentage of the actual purchase?
yeah. So let's just assume you buy a car and it's all business. Like, just for easy, we'll go into the personal one in a second. But let's say it's all business. You buy a delivery van, and you're going to use it just for business. You're probably not going to take your wife out on a date on the on the delivery van, right? So what do you do in that case? You would depreciate it across the life of the car, which is typically 5 years. So if you bought $100,000 car, again, let's just say for easy math. Let's do $10,000 because rules apply differently at the $100,000 rate. But anyways, let's just say you buy a $10,000 car. That means you're able to take, and again, this is all for business. You're able to take $2,000 per year for the next 5 years as a business expense on the cost of a car. That doesn't mean you can't take the mileage rate too. That's separate. But you can depreciate it across 5 years, your vehicle. Sometimes there's credits for certain kinds of vehicles. I'm sure you guys heard of, like, if you buy a heavy duty vehicle, so like a G-Wagon, I believe applies for that, but you can only do up to $150,000, I think, of expense. So there's a lot of people that you kind of hear half the story that say, "Oh, if I buy a G-Wagon, I could expense it all." I was like, "Yeah, you can only expense like half of it." But yeah, because it's considered a heavier vehicle. There's rules for that. Under current tax rules, and again, this might be a little bit more advanced for some of the entrepreneurs on the call. But under current tax rules, there's this thing called bonus tax depreciation, and it's 100% bonus tax depreciation. That's the current rule. What does that mean? That means that you can deduct the whole cost of your vehicle in 1 year at the beginning. So 100%. Instead of waiting 20, 20, 20, 20, 20, 5 times, you just do it one time. That's if you have a banner year where you're making a ton of money this year and you need to come up with more expenses, that's something I would recommend. And I mean, obviously, if you can afford it, I'm not going to say go into debt and buy a car so you can reduce your taxes. Like, that's a terrible idea. But let's say you can afford it, you have extra cash, and you're like, how do I spend this money so I can reduce my taxes? You can buy a vehicle and expenses. So do the 100% bonus depreciation, and your tax accountant can help you with that. But again, it's an easy way to increase your taxes, increase your tax expense, reduce your tax liability, and get something cool for your business. A car. Let's say
With
you use.
regards-
Go ahead.
Oh, just with regards to mileage, how picky are they in logging that properly? And are there? I know now there's a lot of good apps probably for that. Do you have any recommendations that maybe you use or?
Yeah, actually, I don't drive a lot anymore since I do most of my work from home. But what I used to do is you could probably still buy. I'm not even sure they sell them. I'm sure they do, but like you could go Office Depot, and they sell mileage logs, and it's just basically a little agenda where you put the dates at the top, and then you can put like I drove 100 miles to here, or I drove this and that. So there's the old-fashioned way. There's apps, and I can't remember any top of my head, but I mean, if you just put mileage app, you'll find a ton of them. Some are better than others, and the beauty of it is that you just open up your app, and you press go, and then when you stop, you press stop, and then it knows that okay, this is a business mileage.
And how picky are they?
The IRS, again, like we're talking about like pennies on the dollar kind of a thing. Like IRS is not really.
Yeah, maybe you miss a week and you're like, oh, I forgot, and I drove maybe 100 miles that week. I forgot to log it. I'll start logging again now. Oops.
Yeah, like it's like just take a good guesstimate.
Well, not too bad.
Yeah, again, even if your example, 100 miles times 52 cents, what is that? Like $52. Like,
right.
You think the IRS is going to come and like with their SWAT team bust down your door for $52? No, I mean their bullets are more expensive than that, right? So, again, be mindful. Don't get greedy. What's the saying? Pigs get fat, hogs get slaughtered.
Hogs get slaughtered.
Yeah, don't get greedy. Just do what you think is right. You're not allowed. So let's say I had an office, and then from the office I go to meet my clients. I'm not allowed to deduct my mileage to the office, so like my commutes. But I am allowed to deduct count the mileage from my office to my clients, office or to a restaurant where I'm meeting my client and all that kind of stuff. And then on the way home, I'm allowed to take, let's say from my home to my office is 50 miles. And let's say at the end of the day, when I'm at my last client's office, from his office to my home, it's 100 miles. I'm only supposed to take 50 miles because, I would have driven 50 miles anyways from my home to my office. So the commute part is not allowed. You can't use it as an expense. But the other parts are. So anyways, that's another way to deduct your vehicle usage. Same thing with like I was talking about earlier about the computer or your internet plan or your cell phone. Let's say you use your car for personal use too. Again, make a good guesstimate of how much of it is personal, how much it's business. So
what about like proxies and bots and some of the other things that are essential to some people's businesses as well?
When you say bots, you mean like the ones that answer your questions when you? Yeah, I mean that's a business expense.
Yeah, they're
Yeah, I mean, so again,
proxies and everything that costs money.
Yeah, the question would be:
people do.
Would you have that proxy or that bot if you didn't have a business? Probably not. I mean, you wouldn't have.
No.
Yeah, so then it's a business expense. If you had, for some reason, a bot answering your personal questions, I mean, that's a different story. But you wouldn't have a bot answering client questions if you didn't have a business.
So that brings me into like, what about stock and product that you have? Like, if you're buying this stock or this product to sell on terms because you need it for your business and you're reselling it, how would that work?
Well, I mean, that's That's a business expense. So let's say you, I don't know, like I have this little, you guys can't see it, but I have this little squishy football in my hand, and let's say it's a promotional one that I got at some conference or something. But let's say I buy this because I'm going to sell it later on. It's an expense that I took on, so I would put it in my. It's a cost of goods sold for a COGS, cost of goods sold. So if I spend $100 buying all these little footballs, then that's a business expense that you can take. Yeah, does that answer the question? Okay.
Yeah,
awesome.
that answered my question. Really, thank you.
Awesome. Very good. Okay,
just to clarify, let's say the item is $100, you sell it for $120. What's the amount that you can deduct?
Oh, the $100 because that's what it costs you.
Okay, cheers.
So going back to the cost of goods sold. So again, if you buy a box of footballs and for $100 and you sell it for $120, right off the top of your head, you're like, well, my gain was $20. But then there's expenses that go in there besides the cost of the footballs. So, for example, the electricity, employees, rent. That gets added into the cost of goods sold. So your gain may not actually be $20. It's going to be $20 minus all these other expenses you have. So again, make sure you know your cost of goods sold and your margins, so that way you know exactly how much money you're making. A good accountants, a good bookkeeper can help you with that. Actually, that's one thing I would like to bring up. A lot of times people ask me, like, what's the best way to save on my taxes? And I say, well, the best way is to have a good bookkeeper, someone who can keep track of all your expenses that you have. And it might be two people. The bookkeeper may be the person who does your taxes, or it might be a separate person, and that's fine too. You just have to make sure you have someone who's keeping track of how much you're spending and what you're spending it on. At the end of the year, it's always good. I personally do it once a month, and I do my own. And again, mine's pretty simple. I just do a Google Sheets, and I put my expenses, how much money came in, how much money I spent, and on what. And then I look for patterns. I look for income patterns. I said, well, this month, last year, or for the last 3 years, in November, it's a little bit slower. So I know, okay, maybe next year is probably going to be the same. Maybe there's an uptick in the amount, but compared to the rest of the year, it's lower, or a lower number of clients, and that makes sense. So I can forecast that. You can also see variables or outliers. I'm sorry. So, for example, let's say every month I'm spending $100 on internet, and all of a sudden I see $200, and like, wait, that's weird. Like, why am I spending that much money on that? And then I'll have to look into it. And again, for me, it's very simple. I can say, oh, well, that's because I prepaid my Gmail business account. So, okay, that makes sense. Or whatever, right? There's another saying, like, actually, I think it's a Mexican saying. I don't know if it's in English, but basically it says, a cow that's watched gets fat. And basically, in other words, like, if you mind your business, it's going to grow. Again, keep an eye on your business. Because a lot of times we focus so much on making money that we don't, we lose track of where the money is being spent. Again, it doesn't matter how much you make, it matters how much you keep. So get a good bookkeeper. And again, I can recommend several that are very, very good at what they do. And again, they're worth their money in gold. I'm sorry. Here's I'll skip this part. I don't think there's a lot of traders out there, but
Just real quick here, just to touch base back on one last thing we were talking about with the inventory. Let's say like one product that we might get is pools. Let's say we purchase 10 pools and sell 8 of them. We still have some inventory left over. How is that going into the following year? How does that all add in? Does that make sense?
yeah. So there's a thing. There's a I forgot. there's a cash basis. So cash basis is basically the cash basis method is where you count everything that you spend on like right away. So, for example, if I buy again, if I'm doing cash basis and then buy 10 pools today, 10 pools go down as an expense today on my business. And there's I forgot the other way. You put me on the spot right now. I can't remember. I'll have to look at my accounting 101. But in your case, if you have stock now, remainder, you obviously had an expense this year. So you can count as an expense on your accounting books, on your GAAP books. And you would keep the amount. You would have an expense, and then you would have a debit on your stock, your business stock, or like a pool stock account. So that's how it would go. So it would still be an expense. So that wouldn't really matter too much or change that way. For tax purposes, you would have an expense, but you haven't had any sales on it. So yeah, like the same thing would happen for tax purposes. Nothing will really change. It's still an expense this year. Okay, so let's go to the next. Tax trade doesn't look like you guys do a lot of trading, so we'll skip that. Again, we'll skip this part. Basically, put this part here because I know some people do day trading, and a lot of times people have questions about, how do I increase my expenses for a day trader? And most times for day trading, again, like what we were talking about earlier, you get short-term and long-term. If you day trade, by definition, you're doing short-term capital gains. But if the only thing you can deduct is like your maybe your internets. If you buy any subscriptions to day trading magazines or websites or whatever. But that's about it. But if you have tax trader status, this particular allows you to qualify as a business. So actually, all your trades would be considered long-term games. So here's this thing. Again, I'll send this out. You guys can look at if it applies to you. Okay, crypto. Let me show you something real quick. Cryptos are interesting because fairly new for IRS purposes. Last 10 years or so. I kind of kicked myself because in 2010 I had just gotten married and I had $800, and that's when talk about Bitcoin was happening, and I was like, man, I should buy some Bitcoin, and then but I didn't do it because you couldn't go to Coinbase 10 years ago. You had to go. I really don't know actually how you find Bitcoin, but it was kind of weird to go find it, and if you do the math, those $800 that I would have had 10 years ago goes into several $1 million now if it was I had invested or speculated in it. Anyways, let me show you something that's interesting. If you go to the IRS website right here and you type in cryptocurrency, like the top news from the IRS, and again, this is the IRS website, the official IRS website. 7 articles, and they're all about people who got in trouble with crypto. Like the founders of crypto.
Would you say this is probably on the highest part of the concern or growing concern for the IRS is crypto? Or where are they primarily? A reseller, yeah, they might be, whatever, and making 5 or 10, but in my mind, they probably want the tax off the people making a couple million.
Yeah, this is new territory. That's the thing. No one knows. And the IRS has rules. And again, the rules are pretty simple, pretty straightforward. It's pretty much the same as when you had stock. For IRS purposes, cryptocurrency, you have to look up virtual currency on the IRS website to find anything. It's considered an asset. It's considered property. So if you sell it, and you sell it 365 days or 366 days after you bought it is considered long-term gains or losses. If you sell it before then, it's short-term gains.
How's the enforceability in terms of crypto and the IRS? Obviously, with the anonymity and such, kind of that goes with crypto and such. I mean, how is all that?
Again, brand new stuff. This is what I again, I'm gonna take my accountant hat off, and this is just me telling you. I feel that since it's getting a lot of attention, this is probably the worst time to try to do something silly because they're going to set you as an example. They're going to grab someone and put them as an example. Again, like those articles I was showing on the IRS website, like, they went after some people, and I'm sure those people did something wrong, but like something malicious, not just like they made a mistake. They probably did it on purpose. And they're trying to set examples. Like, look, we're not fucking around with this, guys. Like, but again, the rules are if you go here to these links that I put here, the rules are very, very straightforward and simple. If you buy cryptocurrency, if you virtual currency, and you sell it, if there's a gain, you have to pay tax on it. And the rate depends on how long you kept the assets. You keep it for less than a year or more for a year.
Just to clarify real quick, it does go in reverse as well on your loss as well, correct? Up to 3K.
Yeah. Again, it's like buying anything else that you keep.
Right. So just to clarify, just for people that are new into trading, so let's say you lost 10,000, you're still paying the tax on that loss of 10,000, correct?
No, because you're not making $10,000. You only pay in the United States. We only pay taxes on our income, on what we made. Let's say let's say you buy Bitcoin. You buy again, easy math. You bought it for $1, and then you sold it for $10. This is Bitcoin, right? So you made $9, right? Okay. You also bought what's a ETH, Ethereum or Ethereum? What do you call it?
Yep.
You bought that one for $3, but then it went to zero. No, let's do this. No, $3. You bought it for $3, but then it went to zero because they say like, what, this is a big scam. This doesn't exist anymore. Okay, so you made $9 on the Bitcoin. You lost $3 on the other one. What can you do? You'll be able to deduct the $3 that you lost from the $9 that you made on the other one, but then you would still pay $6 of. You would pay taxes on the $6 you made. 9 minus 3. So you paid taxes on the $6.
Okay, just to expand that real quick, let's say you made what you said on Bitcoin, but you held it for 366 days. You held it for over a year. You made $9. Let's say you held that Ethereum and you bought it at 3 and you sold it at 1 and you only held it for 6 months. What's the tax? Where's the tax being paid? It's being paid separate, correct?
Yeah, the tax is only paid on the gain. You don't pay taxes on negative amounts. When you lose money, you don't pay taxes on losing money.
So essentially, in that example, you'd be paying long-term gains on the Bitcoin, and you'd be losing on the Ethereum. So those are two separate. Is that correct? Long-term and the short-term capital gains. They're kind of two different categories. Is that correct? If you're holding, let's say you're holding half your portfolio long and you're trading half your portfolio.
Yep.
Those are separate taxes, correct?
Yes,
Does that make sense?
Yes, but you're only paying taxes on the amounts where you gained.
Right, on the difference of the two. Okay, perfect.
Yeah. So again, like if you lose money, you don't pay taxes on losing money. When you pay taxes on money you make. That's why a lot of times people, when they're starting off their business, I get they hire me to kind of walk them through the process, and they're really worried about the tax entities and offshore accounts and like all this other stuff, LLCs and S corps. And I said, okay, that's great. I'm glad you're thinking about it, but do you know your money's going to make business or not? Like, do you have any sales? And I'm like, no, I don't have any sales. I'm trying to sell like, I don't know, like little visors. And I was like, okay, are people buying it? It's like, well, I don't know. Like, I haven't tried it yet. Okay. First focus on selling things. Then worry about what kind of taxable entity you're going to set up. Why? Because taxes on $0 is still $0. You don't pay taxes on $0. Once you have sales, and let's say you make $1 million in sales, that's great. Like, guess what? It's real easy to figure out once you have money, like paying your taxes. It's easy because you can hire people who help you do it for you. Now you have the money to pay an accountant, some guy like me, to advise you. You have money to pay the taxes, But you spend all this money trying to set up, legal entities, and then, like, oh, I'm going to set up an account here, but I'm also moving into other states, and that money's going to go, to Bahamas or something like that. And it's like, yeah, that's great, man. But if you're not making any money, what's the point? And again, most of those things are for guys like you and I. It doesn't really matter. It's for the Amazons and the Googles of the world. It makes sense, and the Apples of the world makes sense because those guys have literally buildings filled with guys like me who spend all day long figuring out how not to pay taxes. So yeah, like your $100,000 moving into an offshore account, like it's probably not going to be worth the trouble. First of all, because it's going to be expensive, and second, they're probably going to catch you, and then they're going to make an example out of you. So, again, a lot of you guys are entrepreneurs. You probably know this, but if you're not, don't forget about your self-employment taxes. So you have to pay income taxes, yes, but also self-employment taxes. I believe the rate's like a 12.4% or something like that. So don't forget about that. So you usually pay quarterly taxes, quarterly tax estimates. You can do it every 3 months, or you do it every 3 months. A lot of people like to wait until the second to last quarter. So, right about now, I guess last month. And they'll just to figure out how much they owe in self-employment taxes and also their income taxes, and they'll send out a check. I know I'm doing mine pretty soon. I'll do it at the end of the year, but before April 15th, of course. January 15th, I believe, is the deadline. So I'll do mine then. Easy ways to save money in your taxes. Again, an LLC. An LLC is more for legal protections more than anything. If you have an LLC and you have your business assets under your LLC, if someone sues you, if let's say you sell, again, these little footballs and some kid chokes on the little football, and the parents want to sue you, or they can only sue the LLC and whatever money's under the LLC. They can't go after your personal stuff. If you're a sole practitioner and you don't have an LLC, someone could come after your personal stuff. They could come after your bank accounts, your house, your cars, anything. If you don't have an LLC, so an LLC is more than anything. An LLC is considered a pass-through entity, and what that means that the tax liability, an LLC doesn't pay taxes. Why? Because it passes through to the owner of the LLC. And in this case, you, the owner, like if you're a sole practitioner or a partnership. So an LLC
is there any benefit to having the proprietorship over the LLC?
No, I mean it's the same thing. Like an LLC can be for a sole proprietor. So the only benefit is legal purposes. If you're sole practitioner, sole proprietor, and you don't have an LLC, they can go after your personal stuff, your computer, your car,
right?
Wife's
so why
car.
would someone choose a sole proprietor over a LLC if that's the case?
Yeah, I mean, just because it's easy to start.
Oh, so it's easier to get it going. That's why someone would. Okay.
Yeah,
now, can you could you get your sole proprietorship going and then convert it into an LLC?
Yeah.
Okay, and then go ahead.
Yeah, let me tell you real quick. A sole proprietor is not really like a legal entity. It's just you. It's just like my kid right now. My little girl, if she wants to sell her little plants that she grows and make some extra cash for to buy candy, Like she's considered a sole proprietor. Like you don't have to do anything to be a sole proprietor. You just are. So like saying like, can you convert a sole proprietor to an LLC is like, well, I mean,
Okay. Yeah.
but it's like it's you, right? Like, can you become a chef? Like, yeah, but like you're already you. Like we don't create you to make a chef. Like you're just you. So you can make an LLC. And again, I recommend people do an LLC if once they know their money's coming in, because when you have an LLC, there's requirements. You have to file tax returns for the LLC and that kind of stuff. It also might depend on your state, but and you have to keep track of stuff now. Where you're sole proprietor, it's just you. You're 1040.
If a lot of folks here are reselling and kind of probably selling items like maybe electronics and stuff, I don't know where I guess as much risk would be coming in essentially to be sued, to be protected under the LLC.
Yeah.
At what point, I guess, would you recommend someone to switch, to fill out the paperwork and that little, few $100s to get that LLC? At what point?
I say once
venture.
you have recurring revenue, that's a good time to do it. Even if it's $5,000 a month, because now you're making sales and you're dealing with especially if you're doing stuff like that, like you're selling things like a high volume of things. Now you're exposing yourself to.
Let's say you're a Drip LLC, or let's say you're a day trader and a reseller. Is that LLC covering both those quite separate departments, or would you have to have Drip Trading LLC and Drip Resale LLC?
It depends, but I personally would do it separately, and this is the reason why. Remember what I said? When someone sues the LLC, they sue whatever assets are under that LLC. If you have, let's say you have your day trading account, and you have your electronics, you sell stereos on Amazon or whatever. And let's just say, for some reason, one of the stereos you sold came faulty, and they caught a house on fire. That person can get a lawyer, and they can come after the LLC, and they can go after all the assets on the LLC. And in your case, you have assets from another company in there too. Even if it's a different, business, quote unquote business, it's the same LLC, so they can go after all your stuff under that LLC. So I would, and again, if you're doing an LLC, the reason you're doing that is to minimize your risk or your exposure. So I personally would keep my day trading account separate from my stereo selling.
And just to finish that off, let's say some folks are investing a little bit more and more, and they're starting to take some of this resale money and invest it into themselves. And through half the year, they start putting money in and doing some crypto or doing some stocks. How would that all? I'm trying to say it like it would be. They would want to they would want to break it into two, or I can't really describe. Never mind.
Well, I mean, if you're okay, so let's say you have two businesses. You have a business where you do day trading. You have a business where you do stereos on Amazon, right? You sell them on there. What you're saying, correct me if I'm wrong, but what I feel like you're saying is like, I want to make, now I want to try doing crypto, and I want to do it separate from the LLC. Is that what you're saying?
I actually confused myself. Essentially, what I'm saying is, let's say most of these people, most people here are making money reselling, but they're getting into crypto and stocks, and all of a sudden they hit it good, and they're up, 100K or something, or more. And they want to protect that. Let's say they are selling a lot of PlayStations or a lot of electronics that could kind of do what you said, but they're just getting some of this this money from crypto or stocks or whatever else, and they want to protect it. Does that make more sense? They're just getting it now. It's more throughout the year. It's almost the end of the year, but now they're just starting to get it, and they want to protect it.
Yeah, I mean, well, in that case, what I would have done in the beginning is, instead of trading under my LLC, I would have traded under my own personal accounts. Because then that way, when a stereo burns down the house, they can't sue. They can sue the LLC, but they can't sue my personal accounts because that's separate.
Yeah, it makes good sense. Yeah, it does almost seem like having the sole proprietorship in regards to the trading might be more beneficial to begin with until you
Yeah,
get
'cause
it.
I mean, there you're not exposing yourself to anyone. Like you're not dealing with anyone really.
Right,
Uh,
yeah. And there's no real liability there as well because you're just trading. There's no
there's
liability.
no exposure of you
Okay.
getting sued, like
Interesting.
unless you go
Very interesting. I
unless
like
you
that
go
line
and
of
punch some
thinking.
guy in a bar and say like, I'm a day trader, fuck you, and boom, punch them, then they can go after you because they're like, well, punch me. But otherwise, they can't. There's no reason for them to sue you unless you did something to them. Okay, so another way to so again, LC is more through legal protection more than anything. Once you start making serious money, and by serious money I mean like over $150,000 a year, then you might consider getting an S corp. And an S corp that could help you save money on taxes. Why? Because now you're able to pay yourself a salary, and because again, if you're an LC or a sole proprietor, basically same thing, different name, same thing, kind of. And let's say you make $150,000 on selling whatever you sell. All that money is considered income for you, and you would get taxed at whatever tax rate is that amount of income. So 100,000, I can't remember exact number, but let's just say it's like I think it's at 15% or something like that, maybe 20%. So you have to pay taxes on all $100,000. You have to pay 20% after you count your expenses and all that stuff, right? Okay. Let's say you have an S corp. Under an S corp, on top of that, $100,000 when you do a sole proprietor, you have to pay employment taxes on it too. So that's like 12.4%, I think, that you have to pay on taxes there, and then on top of that, the remainder you have to pay income tax. Okay, when you have an S corp, you still have to pay that employment taxes, self-employment taxes, but you only pay self-employment taxes on the salary that you give yourself. So just because you made $100,000 on your S corp doesn't mean you have to pay yourself $100,000. You can pay yourself $20,000. So then you only pay that 12.4% on the $20,000. The other $80,000 would not pay self-employment taxes because it's not considered wages. So it would be considered capital gains. And remember what I said about long-term capital gains? Those are taxed at 15%. So you would actually save money in taxes. So again, once you start hitting that 150, 200,000, and you're going to do that consistently, then I would recommend doing an S corp because that will save you money on taxes. For sure, will save you money on taxes. Also, something a lot of people don't consider when you have an S corp, and you're maybe just you and your husband or wife as employees, or if it's just you can do a thing called a solo 401k. So right now you can do a 401k or you can do a Roth IRA and put money there. So right now you can put up to $6,000 in a Roth IRA. So reduce your income by that, and you save it. You get to keep the money. You get to invest it. You pay taxes when you're withdraw it when you're 65. So if you make $100,000 right now, and you put the $6,000 in your Roth IRA, you only pay taxes on the 94 because $6,000 isn't counted as taxes right now, as income right now. With a Roth, with the S corp, and you have a solo 401k, you can put up to $50,000 as a contribution. So let's say you make $100,000 and you have a solo 401k. You can reduce your income by $50,000 because you put that $50,000 in your 401k. And you only pay taxes on the $50,000 remaining. And let's say you have a wife or a husband or whatever, a spouse. They can also put another $50,000. So then that year, technically you can do like, well, I didn't make any money this year. I don't have to pay any taxes on this. But you have it all. It's through all your money. It's all your 401k. and again, you don't pay taxes until you withdraw it later, right, when you're 65, which is like a wonderful thing because again, you save a lot of money, and you get not only you save money on taxes, but you get to keep your money, which is the best part. Some people, again, you can't withdraw the money without any penalties before you're 65, but you can use it for certain things. If you have, for example, if you're buying a house, you can do a withdrawal for the house to make a down payment on the house. So let's just say you have, let's say again, you have several years putting $100,000 in, 50 from you, 50 for your spouse. You know, you can pull out $300,000, pay your house off in cash, and then pay it back yourself. And you avoid a mortgage and all kinds of stuff. And that money's still yours. That's the beauty of it. That money's still yours. So, anyways, when you start making $150,000 and above consistently a year, that's when I recommend start looking into getting an S corp. Before then, you can do it. The savings are not going to be there that much, and it's going to be more paperwork to keep track of. And again, if you're fine with the paperwork, that's fine. But there's really not a lot of benefits to offer before $150,000 a year. Questions?
I think.
Mate, this is
That Roth 401k, are you saying that in generally only if you have your own business and you're making a certain amount? Oh shit, he closed on me.
I'm here. I'm here.
Oh, you're here. Sure, sorry, my app closed. Yeah. So does that only in regards to that, or are you saying like so? I have a job. I have a 401k. Do you
Yeah.
suggest also getting a Roth 401k to add to that, or should I just do the Roth 401k Roth instead of the 401k?
Yeah, no, you add it on top because so if you have a job, the beauty about having a 401k at work is that usually they match it up to a certain amount.
Mm-hmm.
So you're getting free money. First of all, you're getting free money, which is excellent. And then on top of that, I would say add a Roth RA, RA, so you can deduct an extra $6,000 if you're able to afford it. You can throw in $6,000 and you don't pay tax on that, but you keep the money. The solo 401k, the one where I was talking about $50,000, up to $50,000, that's when you have an S corp.
Got it.
But yeah, I mean, like I have my own Roth IRA separately, and again, every year my wife and I put in $6,000 because that reduces our income by $12,000. So that's $12,000 we don't have to pay taxes on, and we still get to keep it.
Are you doing that through your work, or what if your work doesn't offer a Roth 401 a Roth RA? Do you do it separately?
Yeah, you do it
Somewhere
separately. I use a Ameritrade, TD Ameritrade.
Oh, okay, cool.
But any, like what's the other ones? I can't remember. They're yellow. They have a yellow. I'm sorry, say it again.
Weeble.
I can't hear you. Sorry.
Weeble.
Yeah, I mean, all of them have like options to set up a Roth RA.
I had another question in regards to having like an LLC as a business license, right? How much do you need to be making on reselling and all that to even need to have a business license? Like, if you don't make that much, do you even need a business license, or like
Okay,
what's the?
So an LLC is not a business license. It's just a legal entity. That's what that means. So, I mean, you can have an LLC right now and not do anything. You can set it up and, not even, have an idea what you want to sell or do as a business. You can set up, again, you can go right now and do it. And you have an LLC. But that doesn't mean it, like you have to make money. I mean, again, my little girl, if she wants to sell her little plants that she grows, she can set up an LLC right now. And it's an LLC.
Got you. It's more for like protection, right?
Yeah. but some cities and some states they require you to have a business license, and that's separate than an LLC. That's separate than a taxable entity. Um, I know New York City, for example. You try to do anything in New York City, you have to go get a license. Like, I mean, you can. I can't remember. Someone reached out to me, and we looked it up, and it was something like, again, if they want to sell stereos or something, you have to get a license to sell stereos. In places like Texas, where I'm at, I mean, I can start selling stereos right now, and no one's gonna tell me anything. So the license depends on where you live and that kind of stuff.
Gotcha. What about California?
Yeah, same thing. California is similar to New York in the sense that you have to get licenses for a lot of things.
So do I have to make a certain amount of profit, like to actually get noticed that I don't have a business license?
Again, like
just depends.
It just depends. Okay, so what I know is the tax side of it. For tax purposes, if you're making more than $600 on something, then you probably have to start worrying about that. Not worrying, but just considering taxes. I would imagine the same would be for other things. For example, here in Texas, we have this thing called the cottage. I think it's called the cottage law or something like that. Cottage business law. So basically, it says that my wife, she makes really good jelly out of blackberries that grow out here where we live, and at least for Texas, the cottage law says that she can sell jelly that she makes here at home as long as it's less than $600 that she's making. So I think it's $6 or $500, something like that. It's very similar to the IRS rule, but so she can sell all the jelly she wants as long as she's not making more than $600. Once she starts making $600, that's when she has to figure out whether she needs to get a permit from the health department or that kind of stuff. Again, depends on the state, depends on your jurisdiction, your city, your town, or whatever. But again, the states doesn't really have time to go checking everyone. Again, me personally, I would not worry about licenses and all kinds of other junk until I know I'm making money. Again, once you start making $1,000 a month, selling whatever you sell, and you're like, hey, I want to make sure they don't shut me down, then you can probably say, you know what, I'm going to go get a license, figure out what this is. Because again, by then you're having money, your business works. There's no sense in getting a license for a business you're not sure it's going to work, right? Because you have to pay for the license. So you might as well first test it out, figure if it works, if you're going to make money. Once that's taken care of, we're like, hey, I am making some money. Okay, let me go get the license. As a matter of fact, I'll pay for the license with the cash I made from the business, right? As opposed to coming up with the money up front.
Who's the one that asked that question? About the business license?
Show yourself.
Yeah. Hey,
Okay.
are you from the state?
Were you
Yeah.
you asking who asked it? That was me.
Yeah, so what he's saying is that a business license is separate than an LLC. An LLC is like you're registering your business. It's becoming you're giving an identity with the state and IRS.
Yeah.
A business license is to ask for permission to sell certain things depending on what industry you're in.
Okay, got it.
Yeah, so I think you meant to say like, when do I need to form a business? How much money do I need to make? Yeah, and like he said, $600, you're gonna get a 1099. So.
Well, you won't get a 1099 because you're not working for somebody else, but you will be. You're supposed to report it.
Yeah. No. So yeah, I mean, if you're selling stuff on eBay, though.
Yeah. Right. Yeah. eBay will give you a 1099. That's correct. If it's over X amount, that's all going to change the first of this year. I was going to ask you about that. I don't know because there's not really anything to say about it other than
it's going to
happen. You're not going to be able to hide any money or anything in PayPal or after the 1st of January. The reporting requirements for third-party payment processors are going to be really tight.
That's something, and I know sometimes the news needs to put a headline out there, but like they already know that stuff. Like IRS knows that stuff. Like they know where the money's going and stuff like that. Right now they're kind of just making it a requirement, but they have the ability to look at that money going and coming and all that stuff. So, and a lot of people are, kicking and screaming that like they're taking over our rights and stuff like that. I'm like, they're not. I mean, they know, they already have that information. Now they're just making it official. A lot of times people call me and they have, again, like I mentioned earlier, they have these grand ideas about moving money offshore and all kinds of stuff. And I'm like, look, moving the money offshore is easy. Like that's the easy part. Spending it is the hard part, because they're going to be able to track you down. So, let's say you make $100,000 here. There's actually, I've read a lot about this, and there's places like in the Bahamas and the Cayman Islands and stuff like that, where, let's say you're a dentist here in the United States, and you're trying to, not pay taxes on some of it. But what some of these people do, they want to get it out of the country. So what some of these people do, they'll go buy a Rolex, spend maybe $50,000 on it, whatever, right? Take the Rolex with them with the box and papers and all that stuff, wear it, and take it to the Bahamas. And there's places down there apparently that will buy you the Rolex, or buy the Rolex from you, brand new. I mean, basically brand new, because they just bought it and took it down there. And then they pay you in cash, and then this dentist will go and put that money in a separate bank account down there that's not back over here in the U.S. So now he has, let's say he bought a $50,000 watch, and there's tables. So if you bought this certain kind of Rolex, you could expect to get this much back. So again, you buy it for $50,000, you're not going to get the $50,000 back. You're going to get maybe like $45,000, let's say. But that's kind of what the price you would pay to get the money down there, right? So now you have cash that's untraceable, supposedly, and these people in Bermuda or wherever, they have a Rolex that they sell for a profit, and that's kind of how they make their money. But anyway, so now this American dentist, has his money in offshore accounts. The problem is, how is he going to spend it? He's going to have to spend it outside the country. He can't bring it back into the U.S. And then it's like, well, so you're going to be spending $50,000 at a time, when you're on vacation, or what's the deal? Like, what's the point of doing that? You can't bring it back, because once you bring it back, then they're going to see it. Hey, so how come this money came out from $50,000 or $45,000 showed up in your bank account from some offshore account? Like, that's weird. That's when you get in trouble. So, what I've known some people to do, I have not told them to do this, but what I've been told that people would do is, and this works mostly if you live abroad, they take the money out, they spend money in whatever place they're at, and then this offshore account pays off that credit card. So you don't spend cash, you spend credit. You pay credit, and then this offshore account pays the credit card, which is something like, and again, like that, they can probably track it if they wanted to, but that's not something they focused on. Have any of you guys seen the movie? What's it called? Sicario, the first one.
Yes,
Only the part where people die on YouTube.
Yeah.
it's a good movie.
So,
good movie.
if you remember from the movie, what they were laundering money is, or they weren't laundering money, they were just like taking money across to Mexico. So what they were doing is, the Mexican cartels were taking out big loan amounts from banks. So let's say $1 million loan, right? So they get $1 million, and they can do it for whatever. But then there's a loan. So what the cartel, again in the movie, and they simplified it for, again, it's a movie. What they were doing, the cartel was paying that money back whenever they got a shipment. But then the money was already out there, clean money was already out there, and they were paying the money back, the dirty money. But the IRS or the DEA, wherever, they really don't pay attention to when you're paying credit cards. They're paying attention when you're taking money out, not when you're putting money in for debt. So that's how, in the movie, that's how they were doing it. And that's what some people do to do that kind of stuff, to avoid paying tax on it. Again, you can do it if you want to, but I like to sleep at nights. I like to know that the IRS is not going to come for me.
Did we talk about things that are raising red flags for the IRS when you're doing stuff? What the legal repercussions of not doing your taxes might be? Some of these things, and did
Yeah.
we talk about NFTs as well?
Okay, so NFTs I really don't know a lot about. I would assume that the
It's
the
treated like
treatment-
crypto.
Yeah, the treatment would be just like crypto, like any other assets. If you hold it for less than a year, probably tax rate higher than if you hold it for more than a year. One thing, again, I'm not a lawyer, I'm not a criminal lawyer, so I don't know what like the actual, fines or whatever are. One thing I will tell you, the IRS is very, very, very friendly and understanding, and I'm not being sarcastic. If you ever get a letter from the IRS and you're like, oh crap, what do I do? The first thing you want to do is call the IRS and let them know that you saw the letter and that you want to work on this with them. They'll put a record on it. They have a record of the calls and the accounts and that kind of stuff. So if you say, hey, I received your letter and I'm working on his accountant to help me out, or I'm looking for the documents, whatever, they're very understanding. But the IRS just wants their money, not a penny more, not a penny less, just what they think they're owed. If you jerk them around, if you ignore them, that's when they get pissed. But I've had, me personally, several years ago, I didn't put. I actually lost money on some stock, and I didn't put it correctly in my tax return. I made a mistake, and I got a letter saying that I owe money, I owe $1,500. And I was like, oh crap! And I kind of let it go. Let it go for a month, and let it go for 2 months, and then I got another letter, like, hey, you still owe us the $1,500. And I was like, oh man, like I gotta do something. And I knew it wasn't. I owed them. I made a mistake in the return, but so I needed to correct it. So what I did, I called them, and I said, hey, I got your letter. I'm working on this. I'm doing my 1040X amended return, but I'm working on it. And then they said, oh, well, thanks for calling. We'll make sure we stop sending you the letters. When do you think you'll get it out? I said, I'll get it out by the end of the week. She's like, okay, we'll make sure we put this on your record. And, there's actually some fees due, and they knocked them out. And, interest, that's what it was. And I said, I'm sorry, I made a mistake. I said, oh, okay, no worries. We'll take the interest off. And just send us the thing. You have a month from this call. If we don't get it by the end of the month, then we'll start sending the letters again. But other than that, you're fine. Just send the updated form, which I did, and that was it. I actually got money back because it was again, I made a mistake when I did my tax return. But they're very friendly, very, very willing to work things out. You just have to make sure that you reach out to them. So if you get a letter from the IRS, call them. So that way they have you on record, or a record that you called them and you're trying to work with them.
I have a question on.
Yes.
So, how would you file like local cash sales?
You would just put it in the same way. If you're doing LLC on your Schedule D on your tax return, you would just put it as cash, like a sale, like a normal sale.
Okay.
You don't have to do an invoice or anything like that.
All right. Thanks.
Got a question. I think you might have covered this earlier. You're talking about saving on taxes by buying real estate. Could you go over that again? And for example, if I wanted to save on capital gains, what would that look like?
I mentioned that you can do put in your money in your 401k, a solo 401k for saving on taxes, but saving money.
If it was an investment property, you could, right? If you're buying a rental or something like that.
Right.
Yeah, you really don't save money on taxes. You would save money on taxes.
Well, you wouldn't have to pay the cap. Let's say that it was money that you earned, and you're reinvesting it into another, property or whatever.
Yeah, that doesn't matter. You still have to pay taxes on it.
Okay.
There's a thing called 1031 exchange. That's when you're selling one property to get a similar property, and then you don't have to pay taxes on the sale of the first property.
Whatever
That's-
happened to 1031? I know they were trying to get rid of it, kind of, or there was talk of it. Did that not ever go through?
Yeah, I don't think so. I mean, like, I'm sure the real estate, these big.
Yeah, they
boards-
probably went crazy for that. That's
They
how a lot
just-
of people move their money.
They
Yeah.
made it more restrictive.
So I'm not real familiar with 1031. You know, I don't see it too often. Again, that's kind of like for bigger companies or people who are really into it. But yeah, you really can't save money on your real estate. Like if you make money, you buy real estate. That's not saving money. You can expense some of the stuff you have on there, but again, you had an expense, a bigger expense. You had to drop $100,000 to buy a house, and it's not like you're saving money. You know, you're just paying a little bit less in taxes, but not because you did that, but because you have a investment property.
Let's see. I got one other quick question.
Yeah.
You had mentioned the S corp. You should only look into that if you're making 150K.
Yeah.
What if like you're just getting 150K through like a savings account or something like that? Does it still make sense to go for an S corp? Just like with 1 or 2% returns, it's basically guaranteed through a bank. Okay,
so tell me again. So you made 150,000 and you just want to put it in a bank account?
No, I'm saying like if you're off your 1 or 2% interest in a savings account. I don't know why anyone would do this, but if they did, if you're making 150K just off that, would you still look to go for an S corp?
No, because an S corp would be for a business. I mean, I guess you could have a business and have that business have the bank account, and then put the $50,000 per person from the interest in there. But I mean, again, if you're making $150,000, if you're making interest, that's $50,000 a year. Like that's a lot of money that you're having, and that's probably better put somewhere else, I would imagine. You have to keep in mind you can't do a bunch of S corps and do $50,000 for each one. For your solo 401k, you can only do up to $50,000 total, and that's actually reduced by any amounts you put into your 401k through work, for example.
So, okay. What would some of those other things be to do with your money outside of investing, like just ways to save on taxes? You mentioned there's other things other than the S corp.
I mean, okay, so the S corp and all that stuff, it's more for when you're making money through a business. Like if you get $150,000 and you have like you earn it somewhere, an S corp will help you save money on that. But like if you have the money and you're like, what do I do to save on it? Like there really isn't much you can do. You can save it on your 401k.
And he went over earlier on like deductions and exemptions and stuff like that. So if you want to rewatch it, like, you know, your office space, anything you buy for your business, you can write off your mileage.
Yeah, because you really can't do it if you just if someone dropped $150,000 right now and like what would I do? I mean, I would put as much as I could into a 401k, the solo 401k. But that's really about it. I mean, you really can't do much other than that.
I see. Okay, thank you.
Mm-hmm. What else, guys?
I guess I got one other one on that might be a little bit more applicable. If you were to like, let's say, move all of your crypto into a wallet, and then you just lost that wallet, you forgot the password, whatever, what would the IRS do?
Probably cry for you, first of all. You know, I guess
that's just an argument I've seen online.
Is the internet is the wallet connected to you somehow? Like in the beginning was something in your name or?
Yeah. Let's say you bought like a ledger and you moved everything out of Coinbase into a Ledger S, Nano S, and then you just lost it.
So I would say here, you guys have probably heard about the guy who lost his computer in the landfill, and he's got like 3 billion in crypto or something like that. Have you heard about that?
Yeah.
In that case, I think what would probably happen, they would say, because you really haven't, you lost it, but I guess if like it had like $1 million and you just burned, what would happen? You can only deduct up to $3,000 of the loss. So, yeah, I mean, like, because otherwise anyone could be like, oh yeah, man, I fucking lost $1 million, so I don't pay tax the rest of my life, right?
Right.
Uh,
I wish.
And like, how do I prove it? Like, yeah, I don't know, man. Like, I lost it. I don't know. Figure it out, IRS. They're gonna say, oh, okay, well, you can only do $3,000.
The perspective I'm coming from is just I've read online. You could kind of move some of your crypto through. There's mixers and things like that to kind of anonymize it, put it into a wallet, and then if the IRS ever asks, you just like, oh, I lost it.
Yeah, the other day I got some guy who was doing crypto. He wanted to consult with me, and actually he hired me to talk about this with him. And the guy was like, okay, because there's a wash rule where I can't remember exactly how it goes, but anyways, he was saying, okay, what if I give my crypto to another guy? I have $1 million. I sell it to another guy for $1. And then, but later on, the guy sells it back to me for $2. And then I sell the crypto. Like, well, I only make like $1 in taxes. And it's like, yeah, the IRS is stupid. Like, they know what you did. And I said, well, first of all, like, who are you going to trust to give you your crypto back? Give you $1 million of crypto back? Like, when you gave it to the guy for $1. Because again, the sales fair square, it says right there, you gave me $1 million for $1. For whatever reason you decide to do it, now I have your $1 million. You have to trust that person very, very much for them to give it back to you.
How about like a 501c3 nonprofit? Like you start one up. Is there a way to get the money? Because politicians do that all the time. I mean, how could you do that?
Yeah, I mean, well, you would put it in there. I mean, like,
well, somebody in your family would own this nonprofit, or what I mean, a close friend or something like that.
Yeah. So I mean, you can put the money in there, but you can only take it out at a time. So okay, so you said politicians do it all the time. Like maybe not. It's still kind of like a very difficult way of doing things, and there's probably easier ways. But anyways, so let's pretend that your mom has a nonprofit. You have $1 million, and you say, you know what? Okay, I don't want to pay taxes on this. And let's say you donate the $1 million to them, so you can take it off as a write-off on your tax return, so you don't pay taxes on it.
Mm-hmm.
But then there's that nonprofits, so they have $1 million now. And so what happens? Your mom runs it, and then you decide, you know what? I'm a philanthropist too. I'm going to work for this nonprofit. And, you could spend the money that way, but then everything still belongs to the nonprofit. Like the nonprofit.
Well, the nonprofit would hire a business that is associated with you somehow, but not directly.
Yeah. Okay,
you know what I mean? And they would overpay for whatever services they're getting.
Right. Okay, but then guess who has to pay taxes on that? The
business. Can't the business lose the money somehow? Some type of investment loss, or like isn't there's got to.
Yeah, I mean, so that implies that you're losing money, and like at the end of the day, it's like, well, now I don't have any money. Like,
okay, what if
because I don't have any money because I lost it?
That's a lot of work. Yeah, it's got to be a substantial amount of money to even consider doing something like that, because you'd have to funnel it around so many times.
Yeah. Okay, so let's pretend, we're going to try and make this work. Okay, so my mom owns the nonprofit, or she runs it, right? And it has $1 million. So now we say, okay, we need to get the money out somehow. We got to spend it. So what you could do, and I don't recommend this, but you could, and people are going to look at you weird, and the IRS will probably look at you weird at some point too. They say, okay, well, all the people who work at this nonprofit, they all get Ferraris.
Oh, that trick. Okay.
So then you can, but again, you don't own a Ferrari. The nonprofit owns a Ferrari.
Right, right.
Okay, but you have to drive the Ferrari because you have to go meet the poor people, right? So you
Yeah.
can like give them blankets or whatever, right? Okay, you will get paid. People who work here need to get paid well, so we're going to pay them, $100,000 a year or whatever. The problem there is that you have to pay taxes on that. So I mean, but still, you still get your $100,000. And so you would have to do that until the money runs out. So I mean, you still pay taxes.
How about a church or something like that? You ever
the same
seen?
thing.
Here,